radio for a really great future. We're talking real money.
The heck with stocks. The heck with bonds. Quit saving for retirement in those crazy vehicles. No, ladies and gentlemen, what the world needs now are more annuities. That's apparently what the Wall Street Journal person believes. Hopefully it's just one person, a woman by the name of Olivia Mitchell, wrote a piece in the Wall Street Journal that is entitled, How to Get More People to Buy Annuities. Make them the default option in the 401k. What is she talking about? Hi, everybody. I'm Don McDonald. Tom Cock is over there. This is the Talking Real Money podcast. Tom, what the heck is she talking about?
What she's talking about is, in her own words, is that employers have done a lot of good things in 401k plans in the last couple of decades. Automatically enrolling people, having default options into target date funds. Those are both good things for most people. Then she starts to off into never land, saying, unfortunately, few U.S. companies help employees with the payout phase. That is, making it easier for people to turn their retirement savings into retirement income that they won't outlive. There's a solution for that. She says, make annuities a default option in 401ks and similar retirement savings plans.
Now, I get where she's coming from. I do get it, because I think one of the biggest challenges that most people in the country face when they get to retirement is that creating that determination of how to create the income stream necessary from your portfolio that you've saved and invested in for decades. How do you create that? A lot of people are very challenged by that. But the answer may not be an annuity.
Yeah, in the
there
article,
are problems.
She says economists have long suggested that most retirees should allocate a portion of their nest egg to a lifetime payout annuity. Now, I don't know. She doesn't cite any economists here. I've never heard an economist say that.
No.
And here's the part that I feel is the moment of honesty. She says these insurance products, while not perfect or the right option for every investor, can provide many people with guaranteed income for life, helping them to shield them from the risk of outliving their savings. She then walks through the recent history where the Secure Act 2.0 allows companies to include annuities in their 401k. And I have not seen any numbers on how many of companies have done this, by the way. And while she admits that's a big step forward, she says annuities can be included as an option in plans, but they are legally not allowed to be an employer suggested default. In other words, like a target date fund, they are not the default option. This omission, she says, continues to reinforce existing obstacles that keep many Americans from purchasing annuities and thus protect themselves from running out of income in later life. Now, one thing I question here is, does an annuity necessarily mean your money will last longer? Yeah, I guess it does in some ways.
Well, okay, no. It doesn't guarantee it's going to last longer. It guarantees that it's going to last for as long as you live.
Yeah, there's that.
That's it. That's it.
Remember, most of them are going to pay you a certain amount the same for the next 25 years. Now, remember, things do get more expensive over time. So if you're getting $30,000 a year from an annuity, then and the cost of living goes to $60,000, it's less effective.
She mentioned the problems with the insurance industry and their bad reputation. And that really, but she really didn't mention the shortcomings of annuity. She skipped past those, which, being the suspicious person that I am, I'm kind of feeling like maybe some of her research might be funded by the insurance industry. I'm just guessing. I'm not accusing. That's a feeling I get, because she really doesn't delve into, for example, the joint life aspects and the cost of that, the loss to inflation.
Sure.
The fact that if you don't live very long, the insurance company makes out like a bandit. The fact that the insurance company has all of the upside and very little downside because of their math. They're good at math. They're the wizards of odds. I love that saying.
That's a great saying.
Of odds.
Yeah.
They know the odds. You don't know the odds.
Mr.
And she's
Wizard,
even
if I
saying,
could add one more thing here.
Okay, yeah.
Because she does say the hesitation to purchase annuities has been fueled by the complexity and opacity of the products themselves. Now, but she doesn't answer any, is that true? Is that not true?
It is true, and she doesn't say, should the industry feel bad about that? No, because that's what leads me to believe. When I read this article, I keep thinking there's got to be some financial benefit for the author. There just has to be.
She says this uncertainty is compounded by a history of high fees, aggressive sales tactics, which have eroded a trust in the insurance industry. There's a broader skepticism toward insurance companies, as some individuals doubt these firms will reliably honor lifetime payment promises decades into the future. That's an entirely different topic, of course. But she does not answer her own criticism. This is the part of the article that I thought, well, are those true or not? Are there high fees? Yes, for many products. Are there aggressive sales techniques? Absolutely, 110%. And should we distrust an industry which is really clearly meant, and you can read it in their own stuff, it makes it convoluted. We had the one annuity we read that was 100 pages. And are you going to read all that before you sign on the bottom line, or are you simply going to hear you get 6% a year guaranteed? Not likely after the 6% guaranteed. So they've done that to themselves. That's nothing that others like us have done. So she does not answer, as I say, the criticisms that she raises herself. I think that's troublesome, Don.
Yeah, and I've looked through her other writing, and I don't find criticism of it. I don't find any solutions for the I believe, the serious shortcomings of the insurance industry. And she named them.
She laid them out there for you. And by the way, just because the employer plan does not have an annuity option or makes it a default doesn't mean that people can't retire and then buy an annuity. You can certainly do that. There's nobody stopping you from doing that if you were going to buy one. And we know, because that's the operative word, most of these are sold, not purchased. In other words, they come into the office there. And by the way, if you really want to get an annuity, become a teacher. They come in your office. They tell you why you need to have this. We've seen this. And people buy into these things when they're 30 years old, not realizing that in a general sense, you end up with less money. In a general sense, you paid a lot of fees that you wouldn't have had to pay if you just bought stocks and bonds. And in a general sense, you're still on a plan that's confusing, convoluted, and is going to keep you. This is the part that I really also hate about annuities. If something major comes along in your life, and we have seen that with many retirees, you're not going to be able to get at that money.
No, you've given it up forever.
Yeah, exactly. So that's troublesome to me, the liquidity aspect, again, that people tend not to think of when they hear a guaranteed amount. So, that's here's the other thing. As I said, if you're really interested in making this a default option, why don't you, the author, go out and interview a lot of retired teachers and ask them how they're doing with the annuities they were sold in 1990, 1995.
She's going to tell you that's a different kind of annuity, though.
Oh, okay.
She's going to tell you that that's a variable annuity.
Yeah.
Or some sort of more recently, indexed type annuities.
Yeah, of course she is. Yeah.
And by the way, she's a very, very well-educated, well-respected economist.
Okay.
She teaches at Wharton.
There you
go. Which is, I've heard, a very good school at the University of Pennsylvania.
Yeah.
But anyway, we don't agree that it should be a default option. That you have to opt out.
I didn't want him in the plans
What she's saying is that
I didn't want him there at all. No.
Who?
I don't want annuities in 401k plans.
Oh, I thought you said him. I'm going.
No,
him.
no. I don't. I didn't favor that when it happened 3 years ago. I don't think it's a good. I think a lot of products are going to get sold to people who don't need the product.
Yeah,
we've seen
insurance.
that
The insurance industry loves this kind of stuff.
It's easy access to a lot of big money. No different than adding private equity, crypto, et cetera, to plans. I don't think it's a good idea. Sorry if that sounds like Big Brother, but we've just seen it too many times. People have been sold things that were great for the salesperson. Let's put it that way.
Yep, and so we would suggest that you keep doing what you're doing, finding the best investments for your risk profile, which is tolerance and need, building it steadily reinvesting. And then when you get to retirement, or actually before then, you need to have a plan. I know we keep saying that over and over again, but it doesn't seem like the rest of the industry says it very often.
Because it's more exciting.
It's the basis for everything.
It's more exciting to talk about the products. It's more exciting to talk about the guarantees. It's more exciting to talk about here's how much you could make, not writing a plan that will help you understand what your roadmap is. And as you said, how much risk you should be taking to make it happen. Very few people do that. I'll put it that way. So I'll tell you one thing people do a lot.
They send you questions.
They've been sending a lot of questions lately, which is
they're
great.
typing most of them.
I know. I
don't understand that. It's sort of where we're going. People don't want to talk on the phone. No, don't want to use we're going to lose the ability to talk if we don't use it. If you don't use it,
the phone
you
can
lose
actually
it.
dial people? I didn't know that. Okay, that's good. I thought it was for texting and reading emails. So lots of questions at talkingrealmoney.com. So thank you for sending them. And one comes in from San Antonio, Texas. I love the Riverwalk there. I haven't been there in a long time, but there you go. That's it. He's not editing. He's
that's
becoming
deep in
a
the heart
Texan.
of.
Yeah. Hi, Don and Tom. My wife and I are in our mid-30s, both active duty. So I'm assuming this is military. Thank you for your service. $600,000 saved between 2 Roth TSPs, 2 Roth IRAs, and a brokerage account. That's great. 12% tax bracket. About $215,000 in the brokerage. 150 of that 215 is in 15 to 20 individual stocks that our financial planner, Edward Jones, put us in. My 2 questions. After I move our account to Schwab, well done, Jay. What's the best and most efficient way to sell the individual stocks and buy a total world index fund? That's question 1. Would you like to answer question 1 now?
Little tax planning.
Yeah. I mean, offset winners and losers is part 1. If you
have any losers.
If you got them, yeah.
Yeah.
I went
through my portfolio going, I have nothing I can sell.
No. Well, that's a whole, you're in funds. That's just, basically everything's made money. And then maybe you do it over time. Understand where your bracket is and then start cleaning it up. You don't have to do it all in one fell swoop, but here we are at the end of the year. Maybe you do a little bit this year, do some next year. There's no magic trick to it all, though. You just have to know your bracket and make sure you're not going to bust up to the next one, right?
Yep. Just watch. It's all bracket management.
Yeah, I think that's good. So Jay's question part 2 is, and maybe you'll be better at this than most when you hear it. How do I convince my wife this is the best strategy as she likes owning individual companies?
Sounds like that other question you sent me.
I kept that one for another day. But you go through this in your household a bit. But
because here's the thing. My wife thinks she's smarter than everybody else.
Because she was a stockbroker.
Yeah.
Yeah.
When it comes to money, she's smarter than everybody else.
She is smart. She is smarter than most people.
She's brilliant.
Yeah,
but
she is.
The fact is, none of us are smarter than the market.
No.
None of us. Not even Dr. Mitchell from Wharton.
Yeah. Sorry, Doc.
We're not. We just can't be. And so here's the thing with my wife. At least she's not acting on it anymore.
No, I was going to say, I happen to know that she has some money managed in the method of which we agree.
Yeah.
Yeah.
But if you look in there are some individual stocks that I can't get her to get rid of.
Yeah.
But okay.
Okay, but let's just go back to how do we convince somebody.
Anybody ever disagree with their spouse? Anybody?
How many times?
Show of hands. Show of hands.
In one day, 1 week? That's a lot of hands. I don't have that many hands. Good thing she doesn't listen to the podcast. So, but how do we convince people in a general sense that it makes more sense to buy an index or index-like fund instead of buying and selling individual stocks?
Data.
Track record. Yeah.
Data.
Yeah. It's easy. You can go back and look at the smartest people.
The data totally supports the long-term viability and sensibility of diversified portfolios. The only, quote, evidence you have for stocks being successful is occasional anecdotal reports. Anecdotes aren't data. They're not academic research. They don't really tell you anything. Just because you thought Apple was going to go up and you bought it and it did go up doesn't mean it will always go up. Much as I love Apple, could it stumble? Well, it has before. It could again.
Yeah, but the big picture, there have never been more people, more smart people, more Wharton-educated people spending millions of dollars researching stocks, studying stocks, taking pictures of parking lots, picking individual stocks to beat the market, and not doing it, not making it happen. So the evidence, as you say, Don, the data shows clearly that just owning the market has been the better approach for a long period of time.
And actually, if you want to show her the simple numbers, go look up SPIVA, SPIVA,
yeah.
The Standard & Poor's Index versus Active studies that are done twice a year. What they compare is the stock picking, market timing ability of active fund managers to the indexes that are the closest to their particular style of investing. And consistently, in every single study, you'll find that active managers don't beat indexes, period, in any period. The longer out you go, the worse their performance becomes, which tells you a great deal. If more of them are doing reasonably well short term, you can attribute a lot of that to luck. It is hard to create luck long term.
I think that's well put. All right, another question coming from Denver, Colorado. Jeff writes, hey, I'm retired in my mid-60s. Would like to begin withdrawals from IRA accounts at Vanguard. Can you confirm that automatic contributions to ETFs are allowed at Vanguard, but not automatic withdrawals? We'd have to look that up. I don't know. I'm going to say probably not because of the sales process involved with that, due to the fact versus mutual funds, which they could say, well, we sell those, at the end of the day, like everybody else. And ETFs can be sold during the day, and you'd have to say best price. It gets complicated. Automatic withdrawals seem to be allowed only with mutual funds, not to ETFs. If so, wouldn't retirees with Vanguard accounts want to convert holdings from ETFs to mutual funds? Thanks. Well, first of all, while Don's looking that up, if you're in a qualified account like an IRA, it's fine to own a mutual fund. I mean, you're going to get a similar cost. The funds are, in today's world, operate in a very similar manner, especially if you're using sort of the passive approach from Vanguard, and you don't need the tax help you get from an exchange-traded fund in a IRA or Roth IRA. But if you're in a brokerage account, different situation. But what about that? Automatic withdrawals at Vanguard from exchange-traded
they allow
funds.
Automatic investing, putting money in. You could say, I want $100 a month put in, however often, and it'll just happen for as little as $1.
Wow.
But they don't allow it with all ETFs, by the way. They allow it with all of theirs. Some of the others they do, some of the others they don't. And they don't allow automatic withdrawals from them. No.
I think due to the pricing aspect, probably, right? The fact that when would you sell them, it's complicated.
Well, you could say, I want X number of dollars every month on
times,
the blank, and
I see.
Then, but I don't know why they don't do it. My guess is you're probably right. It may have something to do with the fact that they're worried they're going to get accused of bad executions.
Exactly. Yeah. It's more complicated with an exchange-traded fund than a mutual fund.
I don't know, but the automatic purchases is relatively new.
Oh, as low as $1 too. Wow,
as low as
I'm going to get into
$1.
some of those 5x leveraged funds. Which stocks should I pick,
basically, it's its own ETFs. Sir.
Oh, I see. Okay, that's kind of upsetting.
Yeah, and they can do it with $1 because they'll sell you fractional shares of their own ETFs.
Yeah, their stuff. Yeah, not the 5x leverage.
Right.
I'm kidding. I'm not going to use. Lord. All right. Kyle from Lakeville, Minnesota. Okay, this has some complexity, so please listen carefully. My wife participates in a 401k plan where Aspire appears to be the most favorable option. Typically, the self-managed portfolio offers the lowest cost. In other words, picking the funds, figuring out the percentage, etc. Aspire charges an annual account fee, which I believe is $40, along with 20 basis point management fee. Now, if you're picking the funds yourself, I don't know why you pay a 20 basis point management fee.
They still charge it.
On top of the
fees
40 is just for the open the having
Right,
the
that's
account.
just the paperwork.
Well, I recall that Aspire was one of the primary providers turned to after government implemented stricter reporting requirements. The plan offers a broad selection of mutual funds, including most Vanguard options. Users can also suggest new funds for approval beyond the current list of approximately 652 offerings.
Yeah, no, Aspire is often the only good choice in 403b plans.
That's a lot of funds.
I mean, we looked at
notably-
that. We looked that up with a local Seattle area school district.
I can still remember somebody with an airline who brought the list in 2000, and there was like 700 funds. And I thought, how in the world can anybody be expected to pick from that? But here's the real gets to the gist of it. Notably, there are 3 dimensional funds available. DEMSX, which I took the pleasure of looking up. That's emerging market small cap. These are dimensional funds. DG6, which is the Dimensional Global 60/40. That's a 60% stock, 40% bond. Know that fund well. And DFSCX, which is the DFA Microcap Fund. I made the request to add microcap after listening to Paul Merriman back in 2013. The process for adding new funds generally involves submitting a request for approval. Apparently, they approve a lot with 652 funds. I'm considering adding more DFA funds to our portfolio. If you have suggestions for DFA funds, please let me know, and I will submit them for consideration. By the way, he says, I used to stream Don's show on BTR back in 1999. I didn't even know that it was available online in 1999. Were you still on Business Radio?
I was on BT. I was on Business Talk Radio.
Wow.
Remember, I had gone away.
Business Radio Network.
Well, I was Business Radio Network, and then I went independent when they fired me to replace me with an infomercial. And then
it was one fine infomercial, though. I got to say.
And then I went back to Business Talk Radio, and I also went to, I think it was Talk America, which was the network that Bruce Williams was on there at the end.
Yeah, your hopes, your dreams.
Yeah. I noticed that I'm looking at Aspire's list of funds.
Yeah.
They have lots and lots of Avantis funds.
Oh.
Not ETFs, funds.
Interesting. Yeah, okay, but back to his question. So, first of all, if you're going to use DFSCX, the microcap fund, that should be a very small part of your portfolio.
We're getting into weeds, I think.
It scares me. I would hate to see somebody have more than, 5% of their money in that fund, or even DEMSX, emerging market small cap. Those are pretty risky asset classes. I would expect a lot of volatility there. But your question. So if you really want to build a full suite of funds, dimensional, you could go to their website and pick the right ones.
No. Hold on. Let me just go make this. Do you know how many dimensional funds they have at Aspire already?
Well, he says 3.
No, I have 103.
Okay. He says, notably, there are 3 DFA funds available. So maybe in their individual plan, I don't know how that works.
No, there are 103 in the 401 and the 403.
You should be able to pick
plan.
a pretty but the problem is, again, Kyle and others, how many are you going to pick? I mean, if you're going to use microcap, that suggests you're going to use, you guys still got to have small. You still got to have small value.
You have to have
large.
U.S. microcap. And
that's what I'm saying. You're starting to look at a portfolio of like 15 equity funds. It's just a lot of funds, and then that's got to be rebalanced. I don't know. I mean, if you want to work that hard, I guess, but I'd have to see it to believe it to know that you could build the right portfolio.
I think it makes more sense just to go with one of the core equity funds. Then you own all those things.
I know. Core 2, if they have DFA Core 2, that pretty much covers most of it right there with a small value tilt. You don't get the exposure to micro. I worry that people think that's, and I know Paul loves his small cap value and his micro cap, but I'd be careful if I was self-managing to have a lot of that in my portfolio.
Look there it is. DFQTX, DFA US Core Equity 2.
Yeah, it's a very good fund. I've known it been around for
he knows
15
it well.
years. I've been pals since high school. So, so to add more, if it truly have 100 to pick from, you can go in there and pick, U.S. large cap, U.S. large cap value, go through the whole list. But I'd be careful to build the right thing and to make sure that it's properly rebalanced when it needs it.
I am right on Aspire's fund search website, and I see 103 dimensional funds available.
Wow. That's a great plan. Confusing
and a little expensive.
Okay.
But not terrible.
Yeah, no, that's all right.
And given the other choices that they tend to have in 403Bs, like...
Yeah, we could roll you into a beautiful annuity if you like.
Yeah, they're almost all annuities otherwise.
Lord,
so
please.
Yeah. All right.
Good stuff. Yeah. Great questions. Keep them coming. TalkingRealMoney.com. Click on
the contact form.
Yeah. And then you can either speak the question in and be on Don's show every Friday, which is still my favorite. And this week, all this will be a little dated, but I'll be taking the grandkids to the pumpkin patch listening to Don McDonald as we drive there. So
well, you'll be happy to know that I dedicated this program to your grandsons.
Oh, they'll be loved. If you did, this will be the greatest thing in their life,
did.
probably.
I actually did.
Oh, that is funny. They're gonna go.
I actually did.
Mr. McDonald mentioned us. Oh,
and by the way, for those of you listening to this, the Friday show to which I'm referring happened because this show will not air until November sometime.
Yeah.
That show happened on, so you can go back to it if you want, on October 24th.
Yeah.
Yes.
Okay.
October
I'll be listening
24th.
with both of them then, very carefully. Mm-hmm. That's great. So anyway, you can do all those things.
Compliance approved it even with the mention, so it's good.
They didn't check with them. They didn't sign anything. Well, if they had to, my wife would have 50 signatures by now. So
there's a First Amendment. Just to the
okay, I'm hoping that holds. If you'd like some additional help, if you want to talk to, an advisor, could be me, could
Tom.
be somebody else. Yeah, I'm here working away. I simply go to the same aforementioned, isn't it, talkingrealmoney.com and meet an advisor. Yeah, you just click there. And
you got it right. You got all of it right this time.
I know. I wrote it down. I had to finally
that
put
helps.
it down on paper. Like everything else, it has to be written or
that's why we don't
happen.
That's why we don't do video. We don't want you to see what's going on here.
It's bad. It's bad. Yeah. Anyway, do that. Get your plan. God, I hate to say it. Get your plan in place before 2026, which is hurtling at us at high speed. Yikes. Anyway, do that. So we'll be glad to help you.
We're going to end another one. We hate to do it, but every once in a while we just have to go away for a minute and regroup and come up with ideas to talk to you about and gather up all the questions and all that stuff. But pretty much every single day of the week, we are somewhere on the internet or on the radio talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.